Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenevec on Bloomberg Radio.
Hey, we have a few stocks on our radar, really in the media and related space, if you will. One is on the Magic Kingdom's move into AI. And then, of course, it's the ongoing, not yet ending pursuit of Warner Brothers Discovery. Yes, it goes on. Covering it all, Bloomberg News media reporter Hannah Miller. She's right here in studio. Hey, let's talk, Hannah. We've been talking to you a lot. There's a lot going on. Disney shares a little bit higher. This on news that the company agreed to invest $1 billion in OpenAI and license iconic characters. What do we know about this deal?
Yeah, so we know that it's a big deal.
It does feel like a big deal.
This is really exciting. There's been a lot of tension in Hollywood over the use of AI for film, for animation, things like that. And Disney has made a huge statement here with this investment. And yeah, it's concerning. There are a whole suite of characters. We've got Marvel, Pixar, Star Wars. You can use that with OpenAI's Sora app and kind of create, these short, social media friendly videos using these characters without fear.
What if they have like Mickey as like a slasher dude or something? Like, are they okay with that?
People could write that. People could draw that anyway. That stuff happens anyway.
But there's somebody who's so protective of their IP. Like, you and I have been trying to figure this out.
I think you make a really good point, because if you remember back to the early days of like image generation in the last 3 years, when people were really experimenting with these LLMs and getting them to do stuff, they were actually creating characters that were, Disney would never actually create, or other IP owners would never actually create. And everyone was like, wait a second, this is going to be a huge headache for these companies.
Yeah, so we know from the beginning, like you said, people have been drawn to this. They've been doing, their own creative stuff with these characters. Some of it is fun, some of it is not. So, I'd have to imagine that there's, maybe restrictions here with how people use this app. Like you can put parameters in with these models.
So maybe, okay. The other thing that I think of is just Hollywood's relationship with AI. And when we were at Screen Time earlier this year, a big conversation that we had back in October was about, and this was the whole writer's strike too, and the actor's strike in the last couple of years. This is what was the core tension, right? To what extent are these studios going to use AI from a scripts perspective, from an actual visual effects perspective, to replace us, to supplement us? Does this send a signal about how Disney views this technology to the creative class?
Yeah, I think Bob Iger here, he's going to have to convey a sense of reassurance, to the people working under him. Even though this is a first step forward, I just want to point out you can't use voice with any of these characters. You can't use like Tom Hanks's voice for Woody from Toy Story, for example. But it is still a huge development. And I know a lot of creatives in Hollywood are worried that, they could be replaced.
Why? What?
Go ahead.
Why is Disney doing this?
Yeah.
Is it just, have they done anything internally when it comes to AI on their own? Or like, why are they doing this?
They've filed a lawsuit against Midjourney.
That's the company I was thinking of, yes.
Yeah. So, that was sort of the earlier sentiment that they had.
Yeah.
But, I think what we can see here is they want a piece of the AI pie. That they don't want to be left out or left behind. And this is a way to build a partnership.
With the prom queen, right?
Yes.
Basically, OpenAI. Everybody's just making sure they have some kind of relationship with OpenAI.
Yes.
But apart from, and I think to Carol's point also, apart from the equity investment in OpenAI and getting a piece of that financial upside, if there is financial upside, look, it's still a privately held company. There's a lot of questions about, and even Sam Altman's concerned about OpenAI right now, and there's a lot of competitors. So apart from the financial upside, what else does Disney get by doing this?
They get the lead. And they're ahead of other entertainment companies. They're embracing AI. They also, they get some pluses too, like their employees now have access to ChatGPT, other enterprise tools. So I think they're looking at this from a,
But from a branding perspective, is it like, okay, let's say my kid loves Toy Story and I can use then ChatGPT to create some sort of cool, birthday party invitations for him and his friends for their birthday. Does Disney see that as, okay, well, this is a good use of our brand, an extension that then gets this kid more interested in Toy Story and then going to Disney in California or Florida. Is that the idea?
I think you hit on a great point here that, they're already establishing brand recognition in a new way. Everybody knows Disney, but this is just yet another avenue to get people on board and show that they're a tech-forward company, that they're willing to embrace the future and they're not going to be left behind.
I love what Sam Altman apparently said, right, in an interview with CNBC, that demand for Disney characters is off the charts. So he understands that this is an important part.
Love Disney.
Who doesn't love Mickey or Minnie or Donald?
Well,
or
you think of it as a thing for kids.
Any of them.
But it turns out a lot of adults love Disney.
Yeah, I knew it. I used to know someone kind of growing up who used to love to draw the Disney characters. It was an adult. It wasn't a kid. And investors are, rewarding the company today. So it's interesting. All right.
Well, Disney's focusing on AI. Other companies are focused on, wait, how much is this company going to cost me that I'm going to buy?
Can we get the deal done? Can I stop paying bankers and just sign on the dotted line? We're talking Warner Brothers Discovery. Where are we?
Yeah, so we're waiting right now. Warner Brothers has 10 days to respond to that, hostile takeover bid from Paramount.
So 10 days from Monday?
Monday, and it's 10 business days. They could come back sooner. We could see something as early, as next week. And, they are waiting to see what Warner Brothers says, whether there's going to be a rejection or, maybe they want more information. If they still decide to go with Netflix, Paramount has some options here. There's been a lot of industry talk about whether or not they'll sue. David Ellison has already talked about some frustrations with the bidding process. And there's a shareholder vote on January 8th. So we'll be tracking until then.
Our understanding, too, is Bob Iger also said this morning in comments that he hasn't determined yet if he'll take a position on Warner Brothers. So wait, is this still, Comcast has kind of said we're out, right? We've heard that. But is it possible that Disney somewhere comes in?
I think the race is really tight here already. Why
would he say that?
I think a lot of...
I get his competitors to pay more.
Yeah.
Kind of playing around with them?
Yeah, I don't know. I'm not saying that's why he would do it. But if I were in his position, I would want my competitors to pay as much for other things as possible.
Make it tough.
Yeah. Say, hey, maybe we're sniffing around a little bit. Maybe increase that price.
Yeah. And we know Paramount, they've left it open to an increase. So we could see that down the line.
So what about CNN's fate? Because late yesterday, Carol and I were here in the studio and a headline crossed the Bloomberg terminal. The president essentially saying it should be guaranteed that CNN is part of it or sold separately. This is the president said, any deal for Warner Brothers should include the sale of its CNN cable network. So does that mean that if Paramount Skydance were to win the bid, they would have to shed CNN?
So the thing that President Trump emphasized is he wants to see CNN under new leadership than it currently has. Okay. So that doesn't look as good for the Netflix deal because Netflix only wants the streaming and studios business.
Yeah.
Warner Brothers will then continue with the spinoff of its cable networks, including CNN, and it'll be a separate company called Discovery Global. But it'll still have, the same people at CNN.
Existing leadership will stay.
Yeah, so that's why that doesn't look as good.
So this is about him wanting new people in charge.
Exactly. So it's I think a lot of people in the industry interpreted that as better for Paramount.
Can I ask you something in terms of what we've been talking about, certainly on our planning calls and as a show unit, just what's happening in media and with these deals and ownership and the president's say in this. And now we're talking a lot more traditional, whether it's kind of the old fashioned TV networks, forgive me, or some of the cable guys that have been around for a while, the all newsers. Are we seeing kind of a shift to more conservative leadership and perhaps conservative programming?
Yeah, we've already seen changes at CBS, which is owned by Paramount. And David Ellison has come in, made significant leadership changes there by appointing Barry Weiss, who the founder of the Free Press, as the head of CBS News. And there's been a lot of talk about how that will affect programming. We're still kind of seeing those changes shake out.
Yeah.
But yeah, there has been a lot of talk of, whether Paramount will do similar things with CNN, whether certain anchors will be out. And, there's already just been multiple attacks on CNN from the right.
Yeah, look, I think a lot is still unknown because we don't know who's going to actually ultimately win this deal. Carol mentioned Disney potentially coming in because of the comments that Bob Iger made earlier today. But I'm wondering if you think there are any other parties that we should be watching, or if this is all coming down to just these two companies, Netflix and Paramount Skydance.
We're keeping our attention right now on Paramount and Netflix. That's where we're seeing the action and how that's going to play out. But I can't see the future.
Well, Bernstein weighing in, an analyst there, Lauren Tune, saying Netflix needs to make sure it has an exit strategy in case the bidding war for Warner Brothers, quote, unquote, turns irrational. So, I mean, right, like if you continue, there's a point where maybe then the price doesn't make so much sense. But you do wonder about strategy, how important this is for Netflix.
Netflix shareholders don't love this. I mean, I don't remember the stat yesterday. I think it was 16% in 6 days that Netflix was down. This is its first up session in 6 days. It's down. Look, if you look at June 30th, it's high of $133 a share. Now it's trading at $94 a share. Does that make Netflix think twice that shareholders are not loving this?
Yeah, I mean, we know both parties are going to be tracking the market closely. Warner Brothers is looking at market reaction as well, I'm sure.
Yeah.
With Netflix, I mean, this is a big reversal for them. And they've talked about how they're more of a builder than a buyer. And this is a huge, huge change. There's also a lot of anxiety in Hollywood about this deal and, concerns that, with Netflix emphasizing streaming and considering the theater experience may be outdated, that this would hurt film production and theater attendance.
Yeah, it's kind of fascinating. Our story here, though, about this Bernstein analyst, stock has already lost more than $100 billion in value since it reported earnings in October. So Netflix, investors certainly weighing in and voting pretty clearly on what they think, what they feel about this move by Netflix. I am sure we will be talking to you again. Hannah, thank you so much. Really appreciate all this reporting as we continue to watch this play out. Hannah Miller, media reporter at Bloomberg News, right here in our New York studio.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Can I just say, our next guest walks into the studio and we just get happy, don't we?
You say the same thing about me, right?
Yeah, I do.
Okay, just making sure.
Come on.
We have favorites, but I don't want to make. I want to make sure she's not like, too much of your favorite.
You know you're a favorite.
Go ahead.
But speaking of guests that we love to have walk in, we do love when Lauren Goodwin walks in. She's economist, chief market strategist at New York Life Investments. What I love is that she can look at the economic metrics. She can look at the market metrics. She ties it all together, and she's here in studio. So good to have you here. How are you?
I'm great. It makes me happy to be here too. Thank you for having me.
We're all happy. It's so good. I think we're all happy that we're getting to the end of this year, which has been a wild one. And we just had our last Fed meeting of the year. Did it play out as you expected?
Yes, with a important exception, which is I just really was not expecting Chair Powell to say, we've reached a range of neutral estimates, so your guess is as good as mine. And I think that's super reasonable.
Yeah. It's like Jay Powell gets real, right?
Yeah. And it's, in many ways, it isn't that what he said is unreasonable or super surprising or weird, or there's nothing like that. But the willingness to just open that conversation around, okay, we are in this range of estimates for the neutral rate is so important, because the quibbles that myself and my team have had with the market pricing of the Fed funds rate recently, looking ahead to 2026 has been really, it's on the margin. It's like, look, if we expect pretty good growth and sticky-ish, but nothing problematic on the inflation front, then like, if I say one or two more cuts and you say two or three, like, is that really the difference maker? Probably not. Mm-hmm. But opening this conversation about like, okay, we're in the range of neutral does raise what I think is a really important question, which is as rates move lower, if we get to that 3-ish% range where it's more or less the lower bound of what most people think could be neutral.
For the 10,
for the Fed funds rate, then that's when I think we start to see the market say, no more. And actually that Fed cuts become a problem for the long end.
How do the markets say no more?
By the 10-year moving higher. essentially a curve steepening.
Okay.
That is such a good question. In the sort of 410, 420 range that we've been, I think if as we move below 3, we get 10 or 20 basis points pretty quickly. And if the Fed is not sort of signaling, let's say, any cuts beyond that being on the hawkish side, then we could actually go higher.
So this is something we talked about with Katie Kaminsky of Alpha Simplex, trying to get an idea of what's the upper range. We have quite a range in terms of movements that we've seen, I feel like over the last year or so. So 5%?
I think,
or is that extreme?
I think that would be pretty bad news. I think it's not extreme in the sense that if I look at the economic backdrop of strong growth, a pretty heavy deficit, and still pretty supportive fiscal backdrop next year, and a geopolitical backdrop that's very uncertain. I can come up with 10 or 15 ways that we could get to 5%, but that's not really the scenario I'm talking about. And the reason is, I think that regardless of who sits in the Fed chair seat next year or second half of next year, they don't want that. The president doesn't want that. And so I'm actually not as worried about Fed independence as maybe I would otherwise be as a macro person, because I just think the market's gonna matter.
So
Agreed.
Something that I've been thinking about is if you weren't paying attention to any of the data or alternative data that we've gotten over the last 3 months, you had been taking a long nap, for example.
Oh, that sounds great.
You woke up just to see the press conference yesterday. What was the impression, and what is the impression of the economy that you got from Jay Powell?
Everything's fine. Nothing to see here. And I got to be honest with you.
He sounded more optimistic than I thought.
Well, you said, we keep seeing people letting workers go.
I hear anecdotes about this low hire, low fire environment, and people not getting headhunted at all, and that slowing down so much.
College graduates not getting jobs. So we're trying to kind of square that.
And it seemed like he was everything's kind of fine.
So here's the thing. I want to come back to the college graduates and the low fire, no hire, because I think it's really, really important. And we have been in a soft patch. I believe that we have been in a soft patch this quarter, not helped by the government shutdown, but we've been in a soft patch.
Right.
When you have earnings growth like we have seen, you cannot have a massive wave of layoffs. You could with sort of the technological developments and AI, et cetera, but that's not what's happening right now. And I don't think that's what's going to happen in 2026 either. It is just, look, coming back then to the no hire, no fire. If the market has recovered beautifully this year, but if you're a business of any kind, you are either saying, looking at the Supreme Court decision on tariffs and sort of the business backdrop ahead, and you're saying things actually look pretty good, but I don't know. I'm maybe not leaning in to hire or add 10 people to my team. Or you're saying things look pretty good, but maybe I'll wait to see what happens in the first half of the year before hiring, because this AI thing, maybe we get some synergies. Mm-hmm. So I don't think it's what I'm not seeing from the labor market is a big bearish concern. I'm seeing a wait and see. Yeah. And that's a backdrop where if we see, and I do expect that we will, the benefits of the One Big Beautiful Bill Act for both businesses and consumers pulling us out of this soft patch in the first half, that's probably not a super negative labor market backdrop.
But is it inflationary?
I think so.
Yeah.
I think so.
How badly, or is it manageable? Does it mess up the Fed and its strategy here?
So based on what I heard yesterday, I think our base case is actually pretty aligned with the Fed's, which is so boring. You love to have real fights.
You're in good company, though.
But I think, look, inflation's gone nowhere this year. We've been sitting around 3% for 12 months.
Yeah.
And the answer to your question is I don't actually expect the inflationary backdrop to be incredibly problematic. But we saw these sort of shadow descents yesterday that are suggesting, look, if things go pretty well next year, that is a potential staying where we are, or maybe even seeing a hike by the end of next year for the Fed. That's a good economy. That's a reasonable backdrop.
Right. It's responsible.
It's
in
responsible.
Terms of what the Fed or certain members of the Fed being concerned, right?
Exactly. Now, if you look at, and we did a deep dive on this, I guess a year ago, but if you look at the instances of real double peaks in inflation in U.S. history, and we have a couple, one's after World War II, one's in the 70s, 80s, there are some ingredients that they have, and all of them are possible in 2026. So one of the ingredients you have is you have sort of
got about 35 seconds.
Double dip in goods and labor supply demand imbalance Tariffs could be providing that for inflation. We don't know. You have a super accommodative fiscal policy and artificially low Fed funds rate. Those are not worrisome conditions right now, but that's an outside risk, but the conditions are there.
This is fun.
It's great to see you.
Good to see you. If we don't see you before the end of the year, Happy New Year. And we will certainly see you in the new year. Lauren Goodwin, economist and chief market strategist at New York Life Investments, joining us right here in studio.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
More than 4 years ago, you might remember, I didn't know this happened.
I love the way this story started. Yeah.
So more than 4 years after Warren Buffett let slip, I didn't know this was a slip, that Greg Abel would be succeeding him. The accountant turned energy executive is finally taking the reins of Berkshire Hathaway. It's the $1 trillion conglomerate with businesses that span insurance, freight, and retail, and employs close to 400,000 people.
And I think it was Charlie Munger who actually let it slip. And I think, at their annual meeting, they're together usually at this annual meeting. They're a tag team, if you will. But
great catch, Carol.
Yeah, and just saying Greg will keep the culture. And it was like, so it kind of set things in motion.
So that culture also includes $382 billion. It's a war chest. That's enough to come to the rescue of some of America's largest companies with a single check. We've got a great roundtable on really the future of Berkshire Hathaway.
Let's get to it. Kathy Seifert's with us, Senior Vice President, Equity Analyst at CFRA Research, and Bloomberg News Finance Team Leader here at Bloomberg. Let me say that again, Kat Chiklinski. She's here in studio, staying with us, and we continue our conversation. So good to have both of you with us. Kat, I want to start with you. Here at Bloomberg, you've covered Berkshire for a long time, as has Kathy. But it's the end of an era. It's a real change. And they've been very smart in terms of grooming folks to take over. But nonetheless, it's a massive change for a company so identified with Warren Buffett.
And I think it's going to be...
And Charlie Munger.
Yeah, and it's tough. It's big shoes for Greg Abel to fill. And I think, obviously shareholders know him pretty well. He's been speaking at the annual meeting. He's led the energy business for years. But it's different. And I think it's really going to be an end of an era. And we've already started to see a little bit of signs of what's taking shape there.
What do you mean?
This week, actually, so we saw Todd Combs left Berkshire. He's one of the top stock pickers. He's going to JP Morgan. We also saw they installed a new general counsel, which rare for a modern company these days, not to have a big sort of general counsel.
But they didn't have one.
They didn't have one. They relied on actually Munger, Tolles & Olson for so many years, that law firm. We've already seen these changes that I think Greg in some ways is going to start to run it like a little bit more like a sort of normal modern company, and you're seeing it take shape already.
Kathy, how long have you covered Berkshire?
Oh gosh, do you really want me to do that math? And actually, Kat and I used to talk pretty regularly. I've covered Berkshire for more than 30 years. So yeah. And the interesting thing, now that you've put my tenure on the table, is that up until now, very little changed. It was business as usual. And I think now we're on the cusp of potentially some significant changes. I think some are good. I mean, Kat, you mentioned that they're bringing in a general counsel, which is, kind of striking that they didn't have one before. I think the other thing, and this is a little selfish on my part, they don't have an investor relations function. So as an analyst, it's very difficult to get a really good sense of what management is thinking. The only time you hear from management, and it's not even the full team, is at the annual meeting. And so when this announcement of Warren's retirement was made and they were talking about business as usual, I think there were some of us who follow Berkshire who were kind of hoping it wasn't 100% business as usual.
Kathy, it's funny that you say that we only hear from management at the annual meeting, because Carol and I have actually spoken to some of the portfolio companies of Berkshire Hathaway, and they kind of say the same thing. It's really, really hands off. At least that's how their experience has been. That seems to work, though.
I think one of the management changes that may give us a little bit of a glimmer that Greg may have a little bit more of a buttoned up approach is that, prior to this, you had Warren and then you had the two vice chairmen. You had Greg, who was in charge of all the non-insurance operations, which is a pretty far-flung portfolio, and then Ajit Jain in charge of insurance. And now Greg has elevated the former NetJets head to cover sort of the retail and consumer side of the non-insurance business. Greg is going to retain kind of the energy and industrial portfolio. And then, of course, you have insurance. It's still a very far-flung enterprise. And I think an argument can be made to perhaps not have as decentralized a management style. Take a look at all of the holdings and see if maybe there are some economies of scale to be had from maybe consolidating some of these names. I mean, I wouldn't be surprised if some of that takes place. But I think we also need to discuss kind of the disappointing part of this transition, and that is Todd Combs' departure. I mean, that for me was kind of the biggest deal in all of this.
We want to come back to you. I agree with you. When that hit, I was like, wait, what's going on? And I was also Sri Natarajan here at Bloomberg News, and I'm like, wait, is this Jamie maybe thinking about somebody else as a successor? And he looked at me like I was kind of cuckoo, but I just thought that was such a big move. Kat, remind everybody, and we'll go back to Kathy in a moment, who Todd Combs was at this company.
Yeah, so obviously they have a massive stock portfolio, more than 200, I think 80 billion at this point. And they were beyond Warren Buffett, who controlled a lot of the stocks. There was actually two stock pickers, Ted Weschler and Todd Combs. So by having Todd Combs exit and go to JP Morgan, they lost a huge amount of their sort of equity picking prowess. And I think it's a big move. I mean, I think it means, there's a lot now on Ted to be able to sort of allocate that money. And it's hard these days, It's
a lot of money to allocate.
A lot of money. It's so much easier when you're controlling millions, not billions, and you're actually trying to enter stocks. They can't even enter stocks that easily without affecting the share price. And so they have to be very careful there. So I think this is a huge change at the company. I'll be very curious to see, do they try and get someone else to replace
I was going to say, do they bring somebody else in to
we'll see.
Take Todd's place?
Yeah, I think there's no clarity there yet. But
Kathy, what do you think? Do they bring somebody else in?
Well, so this is the other, there's a couple of other little pieces on the chessboard that we should probably talk about. The other role that Todd played, and, in the near term was even more critical, was he was the head of Geico. And, the insurance business is not a very sexy business, but it's a real integral part of Berkshire's operations. The industry itself is at a little bit of an inflection point. Ajit Jain is in his mid-70s. So Todd leaving not only impacts the investment portfolio, but also some of the operating managerial talent at Geico. And that, that's a big deal. But it also brings up the point of, I think there are two other sort of drop a pin in these two topics and see what happens. And that is, does Ted Weschler stick around? He is the remaining of the Ted and Todd that Kat referenced when they brought in some investment help.
Yeah.
Ted is still there. Does he stick around, number one? And number two, does Ajit Jain, who's in his mid-70s, does he stick around? And then what happens? So, I think there's what we know right now, but there's a few other, I think, areas of potential uncertainty and weakness that I think the investment community certainly has on their mind at this point.
So, Kat, the big question that everybody has is how the investments change. And, there was a lot of questions about, okay, well, what is Warren Buffett's interest in technology? And that question, I think, was answered with an Apple investment many years ago, but it was seen as this sort of turning point. And the company still performed incredibly well, despite the fact that it hasn't made a lot of investments in high-flying tech companies that have performed so well over the last decade. Does that change?
Right.
It's possible to see it change.
Well, I mean, they were late to the Apple game, and it...
I'm sorry. I just want Kat jump in, and then Kathy will come to you.
Oh, sorry.
Apologies.
Too many similar names.
But I was going to say, yeah, I mean, I think it's, I think the technology, they were a little bit late on it, but they made a lot of money on Apple. And like, I do think, there's a chance you could see it change. I think based on what we've learned from Ted and Todd, and now just Ted, like, I think some of his investments echo Buffett's, at least in the philosophy of like, they want to see strong, economic moats. They want to see that the company really is undervalued in ways like that. They really think it could increase over the years to come. So like, and buy and hold stuff. I think a lot of their main strategies will remain, but whether that means they'll still venture a little more into tech or not, I think remains to be seen.
Kathy, just got about 30, 40 seconds. One thing I think about is, Warren Buffett, they're so identified with the company, there for a long time, there through crises. He, like Jamie Dimon, there's a couple of voices out there that we all turn to in moments, in tough times. And we, even when, performance is off a little bit, we trust because the record is long, wide, deep, and really successful. Do we give Greg Abel the same kind of luxury, or does he have to prove himself pretty quickly?
Well, I think your answer is in the year-to-date performance of the stock, because I think the shares have been under pressure because the Buffett premium is sort of coming out of Berkshire Hathaway shares. And I think the investment community has a lot of respect for Greg Abel, but I think he also has enormous shoes to fill. So, I think right now it's very much wait and see. People are being cautious.
Well, we'll be all over it. This was really fun. So appreciate it.
The question is, do they get a new website? I hope not.
Just go there and you'll understand why we said that. Kathy Seifert, Senior VP, Equity Analyst at CFRA Research, and our own Kat Chiklinski, Finance Team Leader at Bloomberg News. This is Bloomberg.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Broadcom's out, so I want to pull these numbers up. Carol, you have them in front of you, right?
Yeah, real quickly, let's go to the outlook. C's first quarter revenue, about $19.1 billion. The estimate on the street is $18.48 billion.
That's big.
Yeah, let's go to the past quarter, fourth quarter, adjusted net revenue. That was a beat, $18.02 billion versus a street estimate of $17.47 billion. Let me go a little bit more to the outlook. C's first quarter revenue, we already mentioned that one, and that one is a beat. We're seeing that stock up almost 7% in the aftermarket. Fourth quarter semiconductor solutions revenue, $11.07 billion. The estimate on the street, $10.74 billion. And fourth quarter adjusted EPS, Tim, $1.95 a share. And that is compared to a street estimate of $1.87. So that one's about 8 cents better than what the street was expecting.
Yeah, shares up about 3.8%, up 4% in the after hours as we speak. Fourth quarter adjusted earnings per share for Broadcom beating estimates. Adjusted EPS coming in at $1.95. This for the fourth quarter. Adjusted net revenue coming in above estimates at $18.02 billion. And Carol, you were also talking about the outlook, which beat estimates. That came in significantly above estimates. First quarter revenue, about $19.1 billion, beating estimates of $18.48 billion.
Yeah, and my apologies. I was looking at Lulu, which was up like 6-7% in the aftermarket. As Tim mentioned, it's now up Broadcom about 3 or 4% here in the aftermarket. And it also looks like Broadcom is increasing its quarterly dividend, regular quarterly cash dividend, to 65 cents a share from the previous dividend of 59 cents per share. So that's what we were projecting here at Bloomberg.
So let's bring back Jay Goldberg. He's had 30 seconds to look at these numbers. He's senior analyst for semiconductors and electronics with Seaport Research Partners. A beat across the board, Jay. Anything in here not to like?
So far, so good. Right. It's a good number. It's not a crazy big blowout, but it's good. On first blush, everything looks fine. I'm content so far. We'll see what they say on the call.
Looking at commentary here off of the press release, quote, we see the momentum continuing in the first quarter and expect AI semiconductor revenue to double year over year to $8.2 billion, driven by custom AI accelerators and Ethernet AI switches.
So the question, Jay, I was going to ask you before those numbers came out, and it's probably even a more pertinent question now, is the connection between Broadcom's earnings and what we see in terms of CapEx from companies like Oracle yesterday. Can you make the connection for us?
Yeah, so I think there's a big distinction here in that a lot of what is going on with NVIDIA is sales to neoclouds, sort of cloud service providers other than the big three.
Yeah, like you're talking about like CoreWeave, for example.
Like CoreWeave and Nebius, right? And to some degree OpenAI. And so there's a little bit of there's a growing amount of concern about the ability of those companies to finance their build out. By comparison, most of Broadcom's customers are very well capitalized. They're big companies who if you can afford to design your own chip, you can afford to pay the bill to actually see the project through to completion. The one big exception to all this, of course, is OpenAI, and like they have deals with NVIDIA and deals with Broadcom to do their own chip. So that's a little bit of a question, but certainly there's less of a financing concern tied to Broadcom's numbers than there is to some of the things that are going on with NVIDIA.
Hey, that number that they expect AI semiconductor revenue to double year over year to $8.2 billion, that's impressive.
It's a big number. They've talked about that before.
Okay.
So that's not a surprise, but it's, they're reiterating that guidance. And I'll tell you one thing that's been interesting this quarter in particular is press releases only tell part of the story. There's been a lot of sort of big after hours swings in some of my names this quarter based on commentary during the call. So I'm kind of curious. Hock Tan, the CEO of Broadcom, is known for having all kinds of interesting color and saying really interesting, colorful things. Mm-hmm. And so I wouldn't be surprised if he has a few more surprises on the call itself.
Like, what do you mean?
When he's bullish, he can be very bullish.
Okay.
Right. We saw that last quarter with them and the quarter before. Back a year ago, nobody thought Broadcom had an AI story. And he started talking about it on the call, and suddenly people realized that not only do they have an AI story, but it's a massive story. And the stock was up 20% that day. And so they're continuing to build on that. And he can, he's very talkative. He might say something interesting.
I mean, what's remarkable about that is if we look at the 1 year chart, I mentioned, up 75% so far this year. Carol, it's up 127% from a year ago.
Yeah, that's why, it's unbelievable. Let's just, in case you're just joining us, shares of Broadcom are up about 2.7% here in the aftermarket, off their highs because they've been a little bit higher coming off of earnings. The big reason that investors are excited here in the aftermarket has to do with the outlook for top line growth. We're talking about Broadcom saying it sees first quarter revenue about $19.1 billion versus an estimate on the street of $18.48 billion. They also expect AI semiconductor revenue to double year over year to $8.2 billion. We've been talking with Jay Goldberg over at Seaport Research, who said that number has been out there before, but they're reiterating them, so doubling down, if you will. And the fourth quarter, looking backwards, net revenue, that was a beat. Fourth quarter adjusted EPS, that was a beat. The company also saying it sees momentum continuing in the first quarter, and then it raised its dividend by about 10% from the prior quarter to 65 cents a share. Top of mind then, Jay, what's your top question here? Or do you just want to let Hock Tan go and see where he goes?
Yeah, one-on-one, I would just let him go and see where he takes us. I think the main things I'm looking out for are what's he going to say about other customers beyond the ones that they've announced? What's the timing of some of these ramps for these new products, and what he sees in the future if they're going to gain some more customers. I think that's all sort of. He said they have a certain number of customers lined up for this, but there's also been a lot of chatter this quarter that they may have won somebody else, like a Microsoft, and so I want to see if he takes the bait and talks about that topic.
I'm looking at Hock Tan, and he's in his mid 70s right now, early 70s.
Yeah.
Do we have questions about succession?
So last quarter, he actually said the board had extended his contract through 2030, and he'd accepted.
Okay.
He has been instrumental in making this company what it is. He's taken it from almost nothing to what it is, massive company today. And so there was a little bit of an overhang. Like, I think people thought he was going to retire next year. But he's clearly, I don't think he's doing it for the money. I think he's just having too much fun, and he's gonna stay with it until 2030.
Hey, Jay, Ardina Bass out with a short right through off of Broadcom and their results. And, she notes that much of the recent buzz around Broadcom stemmed from its ties to some of the biggest AI model providers. And we've been talking about this with you. ChatGPT maker OpenAI signed a pact with Broadcom for its own AI chip designs, while Anthropic agreed to use tens of billions of dollars worth of computing services based on Alphabet's Google Cloud TPUs. The latter components also rely on Broadcom designs, helping fuel investor enthusiasm about the chip maker's AI prospects. We've been talking all about this. Do you want to see Broadcom broaden out, or, man, they're playing with, the bells of the ball, if you will, and so they're in a good position?
I think there's a little bit more broadening they can do. There's a few more customers they can pick up. But the Broadcom model for his entire tenure has been focus on the sort of the biggest customers and just service them extensively, right? When they're a big player in wireless chips, and so their main customer is Apple, and they've been there for Apple for the entire run of the iPhone. And Apple's if you're not Apple, it's hard to get much attention from Broadcom. I think they're going to replicate that model here, and it's worked so far. And I think again, add a Microsoft maybe add an Apple if they ever get into this. But they don't have to add 100 more customers. They don't have to add 10, 2 or 3. Already is driving the numbers pretty significantly.
All right, Jay. We always love it when you hang out with us. Thanks for taking the time, especially on such a busy day. Jay Goldberg, Senior Analyst, Semiconductors and Electronics with Seaport Research Partners.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.